The banks are in turmoil, particularly in Europe, where the economy is stagnant and the regulatory crackdown has been severe. The big banks of the boom years are in retreat, none more so than UBS. So why has Sergio Ermotti, UBS's chief executive, pared back the Swiss banks so much?
Well, I think when we look back into the last, I call it mid-90s, late 90s, and the last 15 years, you saw a lot of banks doing a Me Too strategy, try to be everything to everybody, and therefore probably changing the nature of their own DNAs and trying to do things that were not really well equipped to do. And so what I see is more than shrinking in some cases is also refocusing, and I think this is I think UBS is a good example of that. I think that we are keeping our global ambitions, but in a very focused way, and that's that's the way going forward. So shrinking is not necessarily just leaving up any ambitions to be good at what you're good at.
In the run-up to 2008, UBS in Switzerland, just like Citigroup in the US and RBS in the UK, were icons of global banking, before very quickly becoming icons of a global government bailout program. Can those good times ever return?
When we go back into looking at the pre-crisis, a few years before the real crisis that we saw in 07, 08, was the anomaly. The combination of high liquidity, low cost of capital, triggered, and very liberal and open regulation allowed for this phenomenon to develop, and therefore, people looking at the top line developments as a good indicator for how good the prospects are for a business have been misleading not only bankers but also investors and regulators and the wider public.
Much of the business that used to be core to banking, from advisory work to proprietary trading, has moved out of the sector. Is that a permanent shift?
Again, I think that banks, some of this, ancillary or peripheral activities that are now developing outside the pure banking industry are phenomenon that we saw in the past. Of course, you talk about the boutique phenomenon. I think that one has to go through a different phase of the M&A cycle to see if they are long-term phenomenon that they can still go on forever or not. But I think most importantly, we know that the size of the business, I mean, if you focus on something where you want to be good at, you can be big.
Boosted in part by the problems of the banks and also by a benign investment climate, asset managers like BlackRock have grown dramatically in the last few years. Are they now systemically dangerous?
You're right. I think that is a very difficult topic to cover, because to say that they are not too big to fail as a statement would be totally unrealistic. I mean, you look at the size and the scope and the influence that some of these major asset managers have. By definition, they are too big to fail. If something goes wrong there is a repercussion. On the other hand, you cannot then label the same too big to fail regime that we have as bank into an asset management industry. So I think a credible solution customized to asset management has to be found. So what worries me is when I hear statements like, well, those asset managers are not really managing the bank money, but it's rather more clients' money. I would say this is even more important in that case, that they are carefully watched, and what are the consequences of what they do, intentionally or non-intentionally.
A number of ideas have been floated by regulators in an effort to deal with systemic risk in the fund management industry. Should asset managers be forced to hold minimum levels of cash, for example?
Yes, or maybe just better disclosure and clear understanding about the asset allocation of our clients, and the necessity of really grab cash immediately. So is the understanding of clients. In many cases, more than cash reserves, is have we done enough to educate clients? That's the most fundamental issue.
Until there is a more even regulatory treatment across the financial services industry, banks, the villains of the last crisis, will continue to lose ground to other financial companies. The real trick for regulators will be to spot the problems emerging elsewhere in the system before they cause the kind of havoc that the banks did back in 2008. Patrick Jenkins, Financial Times, London.